Two traders, same account, same position size. Trader A buys a stock that moves $2 a day. Trader B buys a stock that moves $6 a day. Same $50,000, same 500 shares. On a normal day, Trader A swings plus or minus $1,000. Trader B swings plus or minus $3,000. Same position, 3 times the exposure. Now imagine a bad week hits. Which trader panics first? Which one can actually survive? This is what volatility measures, how much something moves, and it changes everything about how you should size. Here's a key insight most people miss. Volatility treats a 10% gain and a 10% loss identically. Both count as a movement. But for you, only the loss is risk. The gain is opportunity. This is why volatility and risk are not the same thing. High volatility does not mean dangerous. It means the range of outcome is wide. Low volatility does not mean safe. It means the range is narrow until it isn't. This is the trap you fell into. When markets are calm for months, you get comfortable. You size bigger. You stop hedging. You stop thinking about exits. Why would you? Everything is working. Then volatility returns and you are way too exposed. The crash does not destroy you. Your position size does. Your position size during the calm destroys you. Low volatility does not mean safe. It means quiet. And quiet is where the trap gets set. So how do you avoid this? Volatility has patterns, predictable behaviors, 3 of them. Once you see them, you can't unsee them. Behavior 1, volatility cluster. Look at this chart. See how the spike come in groups. Large moves follow large moves. Small moves follow small moves. This isn't random, it's physics. When markets get volatile, they stay volatile for a while. When they are calm, they stay calm until they don't. What does this mean for you? If yesterday was wild, today probably will be too. Size smaller, expect wider swings. If you panic sold on day 1 of a spike, you probably sold at the worst possible moment because more volatility was coming either way. Behavior 2, volatility mean reverts. Look at this distribution. Most of the time, volatility sits in a normal range. The extremes, very high or very low, are rare. And here's the edge. Extreme volatility always returns to normal. Always. When you are in a panic, when everything feels like chaos, volatility is probably spiking to an extreme, which means mathematically it's likely to calm down. That's exactly when you panic sold, at the point of maximum fear, which was also the point of maximum mean reversion probability. The math was on your side. Your emotions were not. Behavior 3. Volatility is asymmetric. Down moves are louder than up moves. Look at this. A 5% drop creates more volatility than a 5% rally. When prices fall, fear kicks in. Selling accelerates, spreads widen, everything gets louder. This is why your panic felt so intense. It wasn't just the loss, it was the speed, the violence of the move. Rallies feel slow, crushes feel instant. That asymmetry is real. It's measurable. And it's why you need wider stops during sell-offs than during rallies. 3 behaviors. Clustering. Chaos stays chaotic, calm stays calm. Mean reversion. Extremes always correct. Asymmetry. Down moves hit harder. When you understand these, you stop reacting. You start anticipating. You know the panic moment will pass. You know calm markets are building risk. You know sell-offs feel worse than they are. That's the shift. Knowing this isn't enough. You need to see it, you need to measure it, and one tool makes volatility visible. ATR, average true range. It measures how much something typically moves over 14 days. It captures the full range, high to low, gaps, everything, and it gives you one number. A stock with a $2 ATR moves about $2 per day. A stock with a $6 ATR moves about $6 per day. Remember that panic? That crash? If you would looked at ATR before you sized that position, you would have known exactly how much movement to expect. You wouldn't have been surprised. You wouldn't have been overexposed. Look at these two stocks, both at $100. Stock A, $2 ATR, moves about $2 daily. Stocks B, $6 ATR, moves about $6 daily. Same price, completely different behavior. If you buy the same number of shares in both, you are taking 3x more risk on stock B without even knowing it. This is why people get destroyed. They size based on price or conviction or gut feel, not based on how much the thing actually moves. That's the mistake, and ATR fixes it. For the overall market, watch the VIX. Below 12, extreme calm. This is where traps get set. 15 to 20, normal, business as usual. 20 to 30, elevated, reduce your exposure. Above 30, fear. This is where most people panic sell. Above 40, capitulation. Historically, this is the near bottom. When you were panicking, VIX was probably about 30. That's exactly when mean reversion was most likely. The math said hold, your body said run. Now let's turn this into a rule, something you can use before every trade, so you never get caught oversized again. Position size equal to risk amount divided by ATR into multiplier. Risk amount is how much you're willing to lose. This is from the 1% rule. That's your account times 0.01. ATR, how much it actually moves. Multiplier, how many ATRs away your stop is. Usually it's 1.5 to 3. This formula automatically adjusts your position size to volatility. High volatility, smaller position. Low volatility, larger position. Your dollar risk stays constant. Your exposure adapts. Now let's calculate this. $50,000 account, risking 1%. That's $500. Stock A, $2 ATR, using 2x multiplier from your stop. Stop distance equal $2 into 2, which is a multiplier. So that's equal $4. $500 divided by $4 equal 125 shares. Low volatility stock, larger position allowed, because the expected movement is small. Now stock B, same account, same $500 risk. This is a $6 ATR, 2x multiplier, $12 stop distance. $500 divided by $12 equal 41 shares. 125 shares versus 41 shares. 3x difference in position size. Same risk, different volatility, different sizing. If you would use this formula before that crash, you would have been sized correctly. The drop would have hurt, but it wouldn't have broken you. You wouldn't have panicked because your exposure matched the reality. Now, here's the truth nobody wants to admit. The math is simple. ATR, formula, position size. The hard part is your brain. That panic you felt, that wasn't weakness, it was biology. When markets crash, your amygdala, the brain's fear center, takes over. Same response as a physical threat. Fight or flight. Survival mode. Completely. Your prefrontal cortex, the rational part, goes offline. That's why you could not think clearly. That's why selling felt like the only option. Your brain was trying to save your life. It doesn't know the difference between a tiger and a red candle. This is why you need rules before the crash. In the moment, you cannot think. You can only follow. Now you understand the two traps. Trap 1. The panic sell during a volatility spike. Your brain screams danger. You act to stop the pain. Market mean reverts. You are left behind. Trap 2. You diamond hand, but you're massively oversized because you never adjusted for volatility. So you hold a position that's too big and you hold it for a long time. Both traps come from the same place, not understanding volatility. If you would size correctly, you could have held through the spike. If you would have known about mean reversion, you would not have panicked. The math protects you from your biology. Here's a shift that changes everything. Before, volatility happens to you. After, volatility is information for you. Before, you react to price. After, you prepare for movement. Before, crashes are emergencies. After, crashes are expected, sized for survival. Volatility isn't your enemy. Your position size is. This connects everything we have built so far. Video 1, the 1% rule. How much can I lose? Video 2, position sizing. How much should I bet? Video 3, expected value. Is this bet worth taking? And today, video 4, volatility. How do I adapt when condition changes? The first three assume stable conditions. Volatility is what makes conditions dynamic. It is the multiplier on everything else. Get it wrong and nothing else matters. Expected value tells you if a trade has edge. Volatility tells you how to size it. Risk management ensures you survive long enough for the math to work. That crash that broke you, it wasn't bad luck. It was missing this piece. Now you have it. Here's what to do. Before your next trade, check ATR. Ask, is this stock calm or wild right now? Ask, am I sizing for its actual movement? Ask, if this dropped 2 ATRs tomorrow, could I handle it? If you cannot answer those, you are not ready to enter. Remember that void, that feeling of watching the market climb without you, or holding a position that just keeps falling. You never have to feel that again. Not because you will always be right, you won't, but because you will be sized correctly and you will understand what's happening. Volatility is a primal force. It moves markets, it moves emotions, it moves you. But once you see it, measure it, plan for it, it stops controlling you and starts working for you. Think in odds, act with discipline. See you in the next one.